Welcome back everyone. In this video we will talk about the mother of all variables. It is also the most important parameter which we will be forced to deal with every time we want to enter the market. Volatility. We will introduce the concept of volatility starting with a technical explanation. We will talk about three known types of volatility, and we will focus our interest on just one. At the end of the technicals, we will show you how the application of the concepts of volatility combined with the reading of the financial positions of the operators leads to informational and operational advantages of great value. Let's start and define the word volatility. I would start with the meaning. Under the voice volatility, feminine noun, that refers to the adjective volatile, the dictionary reports. It is volatile, in chemistry, that substance which has the property of rapidly passing to the gaseous state. In computer science, with volatile we refer to that memory in which the data does not remain indefinitely, but only until the system is turned off. And then, changeable, variable, inconstant. In economics, volatility is a statistical index that measures the degree of variability of a financial asset, such as a share, a currency, an interest rate or a derivative, to name a few. Volatility therefore represents the degree of change in the prices of a financial asset. It measures the movements of a given financial instrument over a given period of time. To quantify it, statistical tools are used, such as the standard deviation. However, let's take a small step back, and we will give here a quick specification of the variance and standard deviation, without going into complex mathematical formulas. The first way to define volatility is the concept that statisticians call range, or range of variation. The range is the difference between the maximum and minimum values assumed by our observations. The range is a rough measure, which only takes into account how scattered the data is. Basically, the range considers only the two most extreme values and neglects the rest of the observations. These, for example, could focus around the average value, focus around another value, be towards the extremes, distribute evenly. If we want to take into account how the observations are distributed around the mean, we must use indices that operate on the mean deviation, the standard deviation and the variance. Instead of the range, which refers to only two observations, max and min, we refer to all observations. For each of these, the difference from the average is calculated. The difference is also called deviation. However, this method has a problem. The final result will always be zero. If you calculate the average, then calculate the differences, and then sum up all the differences, the results will always be zero. So the problem is solved with an old mathematical trick, that is, the differences are squared and then averaged. In this way the negatives become positive and the positives remain unchanged. What comes out of the calculation is the variance. The variance, however, provides a squared value that has no real correspondence, and this is where the standard deviation comes into play. The standard deviation is the square root of the variance. This is the measure that we will take into account and that we will use in our reasoning. The standard deviation of a series of observations with respect to its mean is indicated by the Greek letter sigma. When we talk about volatility, we must refer to three types of volatility. Historical volatility, implied volatility, expected volatility. Historical volatility is a simple calculation of the past movements of a given financial market in a given period of time. It can be calculated annually, monthly, weekly. It's the standard deviation of returns. Implied volatility is the market-priced risk rate of an option and is much less simple to calculate. It can be derived backwards on the basis of the price of the underlying, the strike price, the option price, the days to expiry and the interest rate. However, there are various procedures for calculating implied volatility. The best known is the Black and Scholes formula that we saw in one of our lessons. Instead, the expected volatility is the most important nuance of volatility. It allows us to feel the beat of the market. It allows us to take better decisions in relation to the expected movements of the underlying. In short, it is the probability of variation of the price of the underlying within a given period of time. The greater the expected volatility, the higher the price of an option. In our MC4 model, we identify the expected volatility on options with relatively small deltas at around 0.3. This is also called the risk reversal point. The volatility has different impacts on options. In percentage terms, volatility variations affect the OTM options above all. The volatility, unlike the time to maturity, the interest rate, the strike price and the price of the underlying, is the only element not known a priori that has the most important impact on the price of an option. It reflects the expectations of the operators. For example, in a market where most traders have bearish expectations, the implied volatility of the put options will be greater than the call options, and consequently the prices will be different. In practice, three properties of volatility emerge. Cyclicality. Volatility tends to move according cycles. Persistence. Volatility has the memory of the previous stock market session. Regression towards the mean. It is the tendency of volatility to return to average values after reaching both positive and negative extreme values. Volatility is generally expressed as a percentage, and it is calculated on an annual basis. For example, our underlying XYZ has a volatility of 24%. If the index value of the underlying is 3000, the annual estimated movement is therefore 720 points, 3000 by 24%. With a simple formula we can also calculate the daily volatility, starting from the annual volatility. Then, we can calculate the index movement that we expect in one day. So, we take annual volatility and divide it by the square root of 252. Example, square root of 252 equals 15.87. Volatility equals 24%. Therefore 24 divided by 15.87 equals 1.51. To get the prices of the first deviation, multiply 1.51% by the index price. So the range is 45.4 points. What does this value mean? This value tells us that the market will be able to move 720 points in a year, or 45.4 points in a day, with a probability of 68.2%. The expression of volatility is therefore the movement within one standard deviation. This is because the probability distribution of returns is meant to be the classic Gaussian curve, or normal bell. The same principle tells us that, in a day, the underlying can make 90.8 points of movement at 95.4%. This when two standard deviations are considered. Also, the underlying can move 136.2 points at 99.7% probability. This is when three standard deviations are considered. The reality, however, is different from the model. In fact, if we build a distribution of daily returns of an underlying asset, we observe that it does not exactly have the shape of a normal curve. The curve in fact appears asymmetrical. It has a much longer and fatter left tail than the right one. Furthermore, the returns are distributed more tightly around the mean than in a normal distribution. We may name it leptokurtic distribution with a fat left asymmetry. Why this behavior? Because it is more likely the market to fall by 4% than to rise. Hence the probability of an extreme event is relatively higher than the normal curve predicts. This characteristic of the distribution of returns is the basis of the market maker's working method. His task is to adjust the parameters used to price the risk on the options market. You remember, the formula known by everyone for pricing an option is the Black and Scholes model. This model is based on a Gaussian distribution that does not reflect the real distribution. Given fixed parameters as the underlying value, the time to expiry, the risk-free rate and the strike price, the only variable that can be used to adjust the option premiums to the present and future reality is the volatility. In fact, in the chart you are seeing, the implied volatility priced in the options is anything but constant. It decreases towards the right side and increases towards the left side, so the prices of the put options will be generally much higher than the prices of the call options. This leads us to say that, in the equity index options, the implied volatility tends to decrease as the price of the underlying rises. The distribution has a thicker left tail and a thinner right tail than the normal distribution. The volatility smile significantly affects the prices of put options. Even though put options are more expensive, extreme events can never be correctly priced, right, because they are extreme and unexpected. The implied volatility is always an estimate. The expected value is the cost of the probability that an event will happen, but, as we know, reality differs over time, and sometimes quite a lot from the estimates. That said, in our MC4 trading system, we study the behavior of volatility relative to the price of the underlying asset, to the money invested by the operators, expressed in the open interest, to the volumes, to understand the evolution of market negotiations between traders. So, now let's see how volatility behaves according to price movements. We can study 3 empirical hypotheses of volatility smileys. The first is the smile of an uptrend and low volatility market. The ATM volatility is normal. The volatility of the OTM puts is proportionally higher than the volatility of the OTM calls. The low volatility does not affect the slope of the skew to the right. This first example is typical of a market whose prices remain within the first standard deviation for a long time. There is no fear, and no one has a smell of danger. The second smile is typical of a market that is undergoing a retracement phase, and prices are falling in search of support. The implied volatility at the ATM rises and proportionately increases also on the put side and on the call side. This smile reflects a market where some fear begins. There is uncertainty and the prices of the underlying touch the first standard deviation quite often. This fact acts as an alarm bell. The prices of the options rise throughout the chain in a proportional and balanced way. The third smile instead occurs when there are strong movements. The price of the underlying breaks the first standard deviation and comes to the second and sometimes even the third. It is a market where there is really fear, and the fear effect is very well visible on the volatility curve. In fact, this is the case that implied volatility surge. The smile on the ATM ramp up. The OTM options are the most affected. There is an explosion of the prices of the options, no longer proportional but exponential. Traders that have naked strategies on the put side see their margin grow big. It is very hard hedge in this moment because OTM options are far too expensive. Okay, with this simple example, it is easy to understand how the sentiment of the operators greatly influences the premiums of the options. We have to make an operational screening of the volatility conditions before entering the market. Buying options on a Type 3 or Type 2 smile could be very risky because a sudden drop in volatility could destroy much of the time value of the options. Selling options on a Type 1 smile is equivalent to collecting 10-cent coins in front of a steamroller. An increase in volatility would certainly shatter our expectations and jeopardize our portfolio. Too often we hear that volatility is high, or it is low, or that it is too high or too low. And since it is cyclical, it will return to its average sooner or later. There are many studies, one among them the percentile, which try to give answers to operators in understanding where the volatility is. But the percentile is nothing more than a measure. It represents the volatility compared to its historical values in percentage. For example, 90% of the values given are below the 90th percentile. If we are above it, it means that the volatility is high. Stupid reasoning. Even the percentile, despite its beautiful graphs, does not tell us anything. Indeed, it is yet another behavioral bias used by many traders. It provides the illusion that if the value is relatively low it will tend to rise, and if it is too high it will tend to fall. Try asking all those who believed that volatility was high in the first days of March 2020 because the percentile was in the excess zone. The explosion of volatility was only at the beginning, and the percentile remained up in the air near the sky for weeks. So high or low, too much or too little, are not numbers, but only opinions. So how do we say that volatility is high or low? Well, we simply can't say. On the other hand, in our opinion, there is a way to shape the volatility. We can define its value according to the price of the underlying, which has to be related to the distribution of the open interest. In other words, it is important to know where the price of an underlying is according to the money of the operators and its relationship with volatility. In fact, at this point let's see our open interest distribution. And let's give a simple relative high or low value of volatility, corresponding to the levels VA0, VI plus 40, VI minus 40, VI plus 80, VI minus 80. If you have followed the other videos, you should be clear about what happens every time the operational levels are touched. A. VI plus 0, where most of the positions of the operators are neutral to the market. Here the implied volatility is consistently near its average, it is neither high nor low. It is consistent with the sentiment of a market that is in a trading range. B. VI plus 40. Here there are already many endangered positions with negative delta. The market has two paths: to break the resistance or to return within its range. In the first case, the implied volatility tends to ramp up and then suddenly drop when the resistance is broken. In the other case, if the price falls back within the range of VI plus 0, the implied volatility returns to its average. C. VI minus 40. Where endangered bullish positions persist. Here, too, the market has two paths: break the support and drop, or rebound and return inside the range. If the price breaks the support, an increase in volatility is inevitable. Volatility will increase and move away from its average. If, on the other hand, the support holds up, the volatility will tend to fall towards the average value. But when can we define high or low volatility? Only when the real monetary excesses of the market are touched. D. If the underlying price reaches the VI plus 80 area, where almost all bearish positions are in overwhelming danger, we will always see the lows of the implied volatility period. Only in this case we can say that the volatility is low. E. If the underlying price reaches VI minus 80 area, where almost all of the bullish positions are jeopardized, we will always see the highs of the period of implied volatility. Only here we may say that the volatility is high. It is clear now that we have valuable tools to operate effectively in modern financial markets. By combining statistics, the calculation of standard deviations, the value price areas, and the excesses of overhedging, we can understand what is happening on the market. Fine. In the next video you will see a case study of MC4 model. We started long ago, but the journey inside our MC4 model is approaching the end. I am sure you have understood everything, but in case you missed some nuances, please feel free to review some video lessons or contact us. But there is more. Until here you have studied the part of reading the market with MC4. If you liked it, you can find the video course on how to trade with MC4. I wait for you in the operational course, the real trading system, the what to do now, with MC4 levels and volatility. Thanks for watching. Let's move on to the example of MC4 reading.